In trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion. Hey, good afternoon, Market Rebels, from a very chilly South Florida here, Stu, at 73, but I think it's all relative because you made it feel hot down here. What did you say you were up there?
Kind of like options. It's always relative to another.
Always relative.
It's 32 degrees, my friend. 32 degrees.
You only need to say it once. That just sends chills through my body. Ooh, is that cold?
And I think it's mid-April, so I'm not really getting it. But hey, it is what it is, man.
Seems
You
like
got
it's a
it.
little cold.
It's like what we do, Bill. It's you have to work with what the world gives us. And
Exactly
that's it.
right. Yep,
Yeah.
same thing in trading. And today we have a very cool topic that came to us from really, I think, I'm not really sure where we got it. You and I were talking about it, but I think it was more from our Q&As.
Yeah.
We're getting a lot of people talking about leaps. And leaps are fine. We use them, but we also understand what we're doing and what the trade-offs are. Unfortunately, most people think that leaps are a strategy. That's probably one of the big points we want to bring out. Everybody says, I want to learn the leaps strategy. And what we're going to find out is that they can be used strategically, but the word leaps has nothing to do with a strategy. So that's the
No, I
first.
picked up a book the other night. I was in the bookstore, and it was a book entitled 101 Option Strategies and Many Others. So I looked at the table of contents, and it listed iron condors. It had a little subtitle: short iron condors, straddles, broken wings, all these different names. And I feverishly looked for leaps under the strategy content index, and I couldn't find it.
Wasn't there? Okay, there. So there's a good clue right there. But we're going to address this. That's kind of a little sub point, but we hear a lot of people talking about that. We want to clear up the misperceptions. But there's a bigger one that catches people off guard and why they think they're going to have an edge. So the question we have today for our Chalk Talk, Stu, do leaps give you a better chance for profit? This is the reason that we always ask people, why do you want to learn this leaps strategy? And this is usually the thing, at least off the top of my head, that we hear the most, that because I have a better chance for profit.
Because I'm going to buy more time.
I'm going to buy more time, and more time means I've got this long-term upward drift, and therefore we have a better chance.
And everyone, as we go through this is super important stuff. So as we go through this, just kind of keep in your mind that when we talk about where we can create, I don't want to use the word yet, where we create an advantage. That's what we're looking for, right? Where can we pick up an advantage versus somebody else? And people
Okay.
often refer to it as an edge. Do they do I have an edge? So
Mhm.
do leaps give you, well, Bill says here, a better chance of profit. You could also say, do leaps give you an edge?
An edge in that sense, right?
Right?
Right.
And it's just a time frame.
Now,
You're gonna get something just like anything else in this world. You're gonna get something and you're gonna pay
but
for it,
you're gonna give something
right?
up.
And you're
Correct.
going
You're
to
gonna
give
pay.
something up, and it's just, like the soap opera goes as the world turns. I mean, it's just a
That's the
time
part
frame.
that people miss, that you
Yeah.
have to give something up. Now, let's talk a little bit, a very quick dead giveaway we want everybody to think about. Anytime somebody comes up to you, let's say, and says, "Hey, you should trade leaps because they give you an edge." Well,
Oh,
if that were
crap. Did I give
true,
that away? Sorry, man.
who's going to sell it to you? Think about it. That's a very simple way to say that cannot be true. Because if you knew that you always had the edge, let's say like the casino, then why would somebody say, you know what, I'll be the seller of that op. Yeah, I know I'm going to always lose or at least have an edge against me, but don't worry about it. I'm willing to sell it to you. Of course they're not. And the only way they will do it is if they get a higher price, and at that price, the edge is gone. That's the mechanics of it. So there's a good clue right there.
Well, what's the next part of that statement, right? If the edge is gone for the buyer, where must that edge be if there is in fact an edge, right? It has to be on the other side, which is the seller. So it all balances out. And
Right.
what's it called? The fulcrum, right? What's the middle
Yeah.
part,
Yeah.
right? What's
The
balancing the
balancing
whole
point.
thing?
Yep.
Right? The price. The
That's the
price.
price. Right. The edge can't be to the seller either because then the price would come down. But let's look at some of the details. All right. So right now we just want to give you that real quick mental model to say that cannot be true. But let's take a look here at some of the details. So the title for today, Leaps Are Not a Strategy. But then what are they? Good question. Let's go find out. So leaps, and of course I had to put our little registered trademark symbol here because it is a registered trademark. It is an acronym and it stands for Long-Term Equity Anticipation Securities. I know, not the smoothest acronym ever created. I think they tried too hard to make it look like you're leaping out in time. I think they tried to force it, but the reality is it is an acronym. Notice that the S is part of the acronym. It is not plural. It's a leaps option. So I know I didn't make it up, but that's what it is. The definition is there are expirations lasting 9 months to actually up to about 39 months to let's call it roughly 3 years. Some places say 1 year and more, but technically a standard option is 9 months or less. So
9
once you
months.
cross that 9 month mark, that you are into leaps.
Now, what about
Now,
the 5-year ones? What
yeah,
are they?
we're talking about that right here. In
Oh, wow.
2021, the SIBO announced super leaps, but that's for the SPX only. They go out 5 years. But now here's another thing. You brought up a good point yesterday. If we have 9 months, let's say 270 days, we say, oh, that's a regular option. You go out one more day, and now
Go
you're
back to
technically
yesterday.
into a leaps. Well, why would you think that one day suddenly gives you a massive advantage
What changed?
just because it's now labeled leaps?
Yeah, what changed? Nothing.
It's just a label. It's a time frame. It was a marketing thing that the SIBO wanted on here. Now we're not knocking them. We use them all the time, but what we're saying is that you don't get some type of automatic edge just because you're buying a leaps option, and that's what most people think. Now, leaps aren't a strategy. They are a time frame. Again, anything over 9 months and roughly out to 3 years. So here's the benefits of them. Leaps do give you more time to be right. That's usually what traders point to, but they also give you more time to be wrong. That's one of the trade-offs. Forgetting price for a second, assuming even if it's fairly valued, you've got this working against you. More time to be right, but don't stop there. You also have more time to be wrong. So leaps are not more precise. That's more of a short-term thing. They are wider distributions, as we're going to
I
see.
would say that they are actually less precise.
Oh, that's what we're saying there.
From my years of trading, which is
Sure.
many 4 decades plus, I would, when the leaps, when the broker came into the crowd with
Hmm.
a long-term equity anticipation security, it's like, ugh. It's like, the whole matrix is built on an implied volatility that kind of starts in the beginning and
Right.
fans up and down and fans out. And if you think to yourself, like, what's this thing going to be looking like in 2 years in
Who,
terms of
who knows?
range and volatility, and it's like, who knows, man? I mean, the whole thing could be dramatically upside down. But
Right.
meantime, you're trying to price this 2 year option today. It's there's a lot of room for
And again,
error, I
that's
guess, is
one of
what
the that's one of the myths that a lot of amateur kind of novice traders think as they go, well, there's this long-term upward bias, and therefore you have an edge. Well, you also have more chances to be wrong. It's not like all stocks go up. You might be an Enron, right? How did you do if you bought a 3-year leaps on Enron?
not too good.
Not too well, right? And you paid a lot for it. So you are right. They are not more precise. That's more of a short-term option. They are wider distributions. So leaps don't increase the odds of being right. They increase the number of ways to be wrong. And there's a distinction. That does not mean that they're bad, but they do give you more time for your idea to come true. They're a
That's
little
true.
more forgiving. So you don't have to be precisely right like if you're trading a 7-day option. Everything has to line up right.
And I got to come back and say they also give you more time for your idea to become not true.
Exactly right.
Right. It always is going to go both ways. It's just a time frame. That's
That's right.
it.
Right. So
It
they
comes with
changed.
higher Vega. It comes with, we'll get to all that stuff.
Oh, yeah. So they change how wrong you can be and still profit. So again, they have a little more wiggle room, but it doesn't come for free. If anybody wants to pound the table and say, well, this is an edge, okay, then what do you think you have to do to get that edge? Got to pay for it. And now the edge is gone. Anytime there's that you can claim a benefit, you can be 100% certain the market will charge you for it. And now you can no longer claim the benefit because you paid for it.
Hold on. You mean if I go further out in time, I have to pay for it?
Absolutely. Right, you're going to pay for it. We talked about this for our roadshow, one of the demonstrations we were going to do, where I was going to hold up a $10 bill, Stu was going to hold up a $5 bill. We asked the audience, which one is better? And everybody will say the 10. We'll say, very good, you passed the intelligence test right there. Now, step number 2. Stu says, hey, I see that that one's better. I would like to get it. So Stu says, I'd like to have that 10. And I say, not for that 5. What does he have to do? He's got to give me 2 of those babies. So Stu now hands me 2 5s. I hand him the 10, and he holds up the 10 to the class and says, look, everybody, I have an edge because all of you told me this was better. And now I have the thing that's better. And then the class would say, well, how can it be better? You just paid for it. See, that's the part that traders miss when they keep claiming, I have an edge, it's better, I've got long-term upward drift. You're paying for it. And don't ever forget that. That's why you cannot claim that it's an automatic edge. Now let's take a look at the effect of time. Time doesn't really increase risk, it redistributes it. We've talked about this, that risk just migrates somewhere. Leaps reduce your timing risk, like we talked about. In the academic world, we say it's not as fragile. Fragile meaning everything's got to line up right. Think of a 0 DTE. You better be right from the get-go, or it's going to fail.
Pretty
They, they,
much.
they allow you a little bit of wiggle room, but that doesn't mean it's free, and it also means you could wiggle in the wrong direction. So this is why traders feel safer in leaps. They've got lower delta, they don't have any gamma, they're going, it just feels safer. And leaps increase the long-term uncertainty. The probability of being slightly right, and we're going to look at that, and this is also important, shrinks. People say, well, if even if it goes up a little bit, it didn't turn out to be as bullish as I thought, but I was slightly right. You have a lower probability, and that a lot of traders think you have a better probability. We're going to see that in action in just a little bit. So think about that. The probability of being sort of right, your thesis mostly came true, gets reduced. Okay, so they increase this long-term uncertainty. So time is a risk trade-off. It is not a freebie. Now, here's another key point that I want everyone to write down. Anytime a strategy promises safety or feels safer, check the tails. That's where risk is going to migrate to. So, for instance, naked puts. They win 85% of the time. They're so far out of the money, it's like printing money. It's free money. Check the tails. That's where the risk is. Guarantee it. Locking in gains. Hey, I'm up a certain percent. Let's lock it in and move out. Does that feel safer? Yep. Check the tails. That's where the risk is. Generating income. Oh, it's safer because I've got all these credits coming in on my covered calls and I'm reducing my cost basis. Does that sound safer? At least that's what the story is. Yes. Check the tails. That is a 100% guaranteed clue where that risk is hiding. So let's take a look at this. Now, we saw this last week, didn't we, Stu, when we looked at our coin flipping game? If you didn't see that, go check it out. I thought it was a very cool demonstration. But we found out that as we flip that coin, that the distribution starts to shrink, right? We had this very wide distribution in black. And then as we continued to flip, what happened? We start compressing the tails. In other words, when we had less time, right? Time was these flips. As time was going by, we compress the tails. We get more area in the center because we're becoming more confident of where we're going to land. So now reverse it. When we went back to the beginning, what must be true? The tails must expand. And that's the part that people forget. Now, we also looked at this in a very old coach's corner. If we look at 20 tosses of a coin and you had to predict the number of heads or the number of tails, your best guess is 10. That red bar right there, that is your best guess. But look at that, you're only right 18% of the time. Okay, 82% of the time you're wrong, even though it's your best guess. And so traders think, oh, it's the best. It's the thing that's most likely to happen. That doesn't mean that it's a relative high probability. Now, what happens if we go to 50 flips? Will you have more confidence? See, most people think yes, but that's the same thing as increasing time. What do you suppose is going to happen to that probability? Look at that. Now, yes, we did shrink this way, but the center bar compressed. What happens if we go to 100 tosses? See, now it's only 8% is your best guess. You're going to be wrong 92% of the time. So there you can see that as we go out with additional flips, the bell curve gets shorter and
Wider.
That's what's happening with your leaps. You are reducing the center. That's why it's harder to be slightly right, because there's far more area that gets shoved into the tails. So more time, the less confident you are about observing the average. That is important. So don't go out there and rush out and say, I want to learn the leap strategy because I get an edge and it's going to be free money. That's a
Which is just a
huge,
fancy way of saying, like, where's the stock going to be in 2 years?
yeah, exactly.
I don't know.
Right. So
I mean,
now let's do this. Let's have some fun with this. I said we'd look at a demonstration. This is just another way to demonstrate what we've been talking about. So here is a coin flipping simulation. We're going to start down here at 0. And so we're going to do 1, 2, 3, 4 flips. So this column is our first flip. There are the possibilities after the second, the third, and the fourth. So we could start out with flipping ahead, right, on our first flip, or we could get tails, only 2 outcomes. After the second flip, what happens? We could go head, head. We could go head, tails. Now, I made these X's. If we're moving down, it's a tail. If we move up, it's a head, rather than having to write heads, tails there. So that would be getting heads first and then tails. Or we could get tails, heads, and then tails, tails. There's 4 different things that we could get. And over here are the complete list. There's 16 possibilities. That's just 2 times 2 times 2 times 2, right? 2 outcomes, 4 different times, 2 to the 4th. So there's all heads. There's getting 3 heads and 1 tail. There's 3 heads. There's another way of getting 3 heads and 1 tail, and so on. Okay, so now that's the explanation of our chart. Let's take a look at what's going on here. Let's say that this is an option, and which, by the way, you can price an option with coin flips. Not metaphorically, you can price them. And in fact, that's called a binomial pricing model. Just two outcomes, up or down. And so let's say that we are interested in getting two or more heads. So this could be like our strike. Maybe this is our strike and we're saying we want to know the probability that we're above here. So how many ways could we get two heads to? Well, we have to count the number of paths. So I could get to two, I could go 1, 2, 3, 4. That would be one way to get two heads. I could do this way, that way. I could then walk here. There's lots of ways that we can get there. But now, let's see of how many that could actually be into play. Well, we line up here from 2. We'd have to at least be on that path, or this one, or this one, or up here where we got 4 heads. If we ever wander into this range, done. And you've heard me talk about that with any option, kind of, I call it a statistical point of no return, or wandering into a bad neighborhood. You need to understand when you get into here, because the probabilities of getting up here, in this case, are 0. If you tag any one of those, you have no chance of getting 2 or more. You're in just bad branches of the tree. So now we know we have to be somewhere in here to get 2 or more. And the question is, how many are there? How many different paths are there? It's hard to see. Well, it turns out over here to get 4 heads, there's only one way, and that would be that one right there. That's the same thing as just marching straight up that way. How many ways are there to get 3 heads? So I could sit there and say, well, there's one way, there's head, head, there's a second way, there's 3 heads and 1 tail, there's 3 heads and 1 tail. Well, it turns out there are 4 ways. And how many ways are there to get 2 heads? There are 6 ways. Now, how many ways are there total? 16. We just talked about that. There they are. 2 to the 4th. So there's 11 ways to get 2 or more. Think of our strike. Out of what? 16. We have a 68, almost a 69% chance of getting 2 or more. All right, now hold that thought. Now let's do it with 10. What happens? If we're going to do it with 10 and get 5 or more, that's the halfway point. We have to either be on that, that's the very last route we could take. We could be up here. We could be anywhere along here. And we could also be along here. If you ever wander into these areas, your probability is 0 of getting there. And this is why a lot of times a trader stock will wander down into here and they'll say, oh, don't worry about it. We got 2 years left. Yes, but you can't hit your strike, statistically speaking. So now the question is, how many ways are there to get 5, Stu? Well, it turns out if we look at 10, to get 10 heads, there's only one way, right? We have to walk that path right there. It's the only way to get 10 heads. To get 9 heads, there are 10 ways, right? We could come up here, we could come up there. There's different 9 ways. We could do 8 heads, there's 45 ways. 7 heads, there's 120. Those start to get kind of hard to see. 6 heads, there's 210, and 5 heads, there's 252. So there's 638 ways. There's 1,024 total. That's just 2 times 2 times 2, 10 times, right? 2 raised to the 10th. What happened to our probability?
Looks like it went down.
Went down 62.3. See, we were at 68.8 to hit the halfway. So there is a very direct proof, without having to get into bell curves and some of the messy math that comes along with them, to visualize what's happening. That center has to get compressed, and that's because you're now starting to get more possibilities out here in the tails. It's got to go somewhere. It
So
comes
what are you
out of the
saying here,
center.
Bill? The more time you have, the more pass you have, the less probability you have.
The less probability you have of landing in the center or being sort of right. You're either going to be right, let your thesis play out, or you're going to be really wrong.
So, you got to think about this intuitively. The more pass, the more time you have, the more pass you have.
Yep.
And the more pass you have, the lower the probability. So
The
what's it? So go back, full circle. Does time give you the edge? No.
no, no, it does not. That is a fallacy, and we hear it all the time in Q&A. People say, I want to learn the LEAPS strategy. First of all, it's not a strategy, it's a time frame. When we ask them why, they say, because there's a long-term upward bias in stocks and I have an edge. That is a complete fallacy. Proof number one, nobody's going to sell it to you if you absolutely have an edge. And number two, what we're showing you here is a mathematical proof. And this is something that Stu and I like to do for everybody. There's so much opinions out there. Here's what I think the stock is going to, no, that's a dime a dozen, right? Roscoe's got an opinion. Who cares? What we want to show you are the mechanics and the math and the things that must hold true. This must hold true. Now, we're not saying leaps are bad. We use them in our ICF strategy, but we're very aware of how we use them. We're playing the left tail. We're keeping them in the money. Those are topics for a different day. But we don't buy them just because we have this blind belief that, hey, Stu, if you buy a Leaps, it's free money.
There's so much
That's
more to the discussion
so much more.
than well, it's it's 2 years, or
Right.
there's the well, if there's the higher delta on the out of the monies, there's the lower delta on the in the monies, there's the higher vega if you go further out in time. Do you
That's
want to
a
be exposed to
huge
that
risk.
higher
Yep.
level of sensitivity to changes in applied volatility?
Yep.
There's a rogue component to that, especially when you're getting into the world that we live in these days, which
It
are five,
doesn't
six,
come up
seven, eight
often.
hundred dollar stocks. I mean, it
That can
that
crush
interest
you.
is a lot of money. I mean, it's big exposure. It doesn't mean anything on a 2 week $4 option, but on a $40 option or 50 or $100 option that goes out 2 years, it's buku money.
Or
So
$3,000 stock, and you've got 10 contracts and interest rates come down from 5 to 3%. You need to understand what could happen.
yeah,
Right.
and all these dynamics really enter into it. And it's not just the time, it's just there's other factors involved. If you want to go out in time to buy a stock replacement option, you have to go farther, you have to go more in the money to get the delta that you're looking for. Well, that puts you in a place where you have to buck up more intrinsic value, and maybe you don't really want to do that. But
Yep.
you have to know the ins and outs of what the longer time period involves. It's not just let me buy some time and I'm going to be better off. It doesn't work that way.
It never
People
works that
espouse
way.
that all the time, and it's just simply not true.
And
It's
that's
just
actually why you brought up a good point about going in the money. When we do that, we get away from rho. More importantly, we get away from vega. We get a high delta. We get away from gamma. It is mostly stock. Is that a benefit? Yes. What did we just say about benefits? You got to pay for it. Yes, they're going to be more expensive in terms of dollars, but we're just playing that far left tail and saying that's not going to come into play.
which
That's
is assuming, everyone, that you want your position to look like a stock
to
position.
look like a stock position. But what a lot of traders do is they say, well, let's go way out of the money
Yeah, let's
because
go
there's this
shopping. Oh, I can afford that
I could
one.
yeah, this here's an $8 option. I can go out of the money. And the reason it's still an edge is because there's this long-term upward bias and it's free money. That is
Negative.
like
You just dug your hole
you
deeper.
just dug your hole. Yeah. Yeah,
Yeah.
it's probably a bad thing.
Yeah.
So we just wanted
And
to kind of
and if you get and then and then there's the theta curve, I mean, it's like if you're on that out of the money curve versus you're at the money curve, that more money's going to come out in the beginning part as opposed to the end part. Everybody thinks it's that thing that goes down. It's actually the other way around. So
that's right.
all these things have to be
Dealt with.
taken into account when you're talking about whatever option it is that you're talking about. Do you want the delta? Do you not want the delta? Are you looking for time to give you the delta? Are you looking for, Vega? Are you not looking for Vega? What is it that it always comes, Bill, doesn't it always come back to what are you trying to do?
What's your goal? What are you trying to
What
do?
don't you want? If you say what am I trying to do and what don't I want, it really makes it pretty simple about how to create the strategy
If you
by
understand options,
process of
right? You have
elimination.
to. Yep. So here's a good little tip that we're going to leave you with. Anytime somebody says, hey, Stu, you know what? I read about these leaps strategies. You should buy them because you have an edge. Here's a good little clue. Ask yourself, what are the trade offs? And if you can't list the trade-offs, hit the think yellow light. That's what we like to talk about. Just think about it. Make sure that you understand what you're getting into, and that's a very good safety question. So you heard Stu just rattle off a whole bunch of, we had interest rates, we have Vega, we have the theta curve, we have intrinsic versus extrinsic. You need to understand all of those, not just somebody told me buy leaps because you have an edge. So with that, what do y'all think? Do leaps give you a better chance for profit? Worded that way, I would say no. You're not more likely to be right. You're just less likely to be wrong immediately. You do
Yeah,
have more wiggle room.
it's the
Uh,
usual, like it depends. Look, you
you've
can
got
spin it
wider
any way
tails.
you want, but the
Yep.
bottom line is the time you pay for.
Yep.
One way or
Exactly.
another,
You got to pay
you're
for
you're
it.
you're paying for it. So does that if you pay what you believe to be lower than what you should be paying, does that give you an edge? Maybe,
Maybe.
but who's to say that you're actually buying something lower than what you think you should
That's a
be
belief.
paying? I mean,
Correct. That's a
because
belief.
somebody's willing to sell it to you, it doesn't mean
Right.
that you just got an edge. I've heard things like, "Oh, I can't believe they're selling them that low." Really?
There's no way to know that.
Well, why does the other side think that they're okay to be selling them at that
That's right.
price? I mean, you don't, what makes your decision better than the next guy's decision?
Yeah. We've talked about that in Q&A where price is a point of agreement because that's where the trade takes place, but it's also a point of disagreement because that's where we disagree about value. The
Value.
buyer thinks the price is too low, the seller thinks it's too high. That's why they come and agree on that price. So
Price does
like Stu
not
was
have to
saying,
be value.
just because you say, "Oh, I've got an edge," why did the other person sell it to you? Think yellow light and just think, and that's going to
Just
keep
think
you
about it.
from
Yeah.
making big mistakes. So we hope that gives you some good stuff to think about. And I think that's pretty good time to wrap up here. We want to thank you all for joining. Please make sure you hit that the likes and subscribe button, and we will see you next week on Coach's Corner. We'll see you then.